Hello, everyone. Welcome to the last video on Chapter 10. So we've been talking about registered savings plans, specifically for retirement. But sometimes when someone retires, they might get additional salary amounts, perhaps bonuses related to retirement that are outside of these pension plans. So we're going to talk in this last video about what to do with those amounts. The most common type of cash payment you might get at retirement is called a retirement allowance or retiring allowance. This is once you've reached the end of your career, you've worked for an organization, especially if you've been there 30 or 40 years, they might recognize your long-time commitment to the company by providing you, you could call it kind of a bonus upon retirement. So it's excess funds that they give to you in one lump sum to say, these funds are to recognize your contribution to us, your loyalty, and it's to help, get you through retirement, help put towards keeping you comfortable in retirement. Um, this is often done by companies that don't have a registered pension plan, or at least didn't have one many years ago when the person started working. So they're not able to provide that kind of comfortability in retirement. So they might say to recognize your efforts towards the company, your long time performance and commitment. Here's some retirement allowance for you. So the government says the retiring allowance will be entirely included in net income, which we always do whenever we receive cash from our employer, but we can immediately transfer some of that allowance to our RSP and not worry about how it affects our contribution space. So if we individually have an RSP and our work gives us a lump sum on the day of our retirement, we're allowed to transfer a part of that directly into our RSP without affecting contribution space. So if we have no contribution space left, we can still do this. But the amount that we can do, that we can transfer, is dependent on how long we've been with the company. So these rollover amounts are only available to years starting prior to 1996. So the only time you see anyone actually benefit from these rules on retiring allowances are individuals who have been with a company for at least 30 years. So they've retired, they've been there 30 years. They can transfer $2,000 for each year prior to 1996. And this amount goes down to $1,500 to each year prior to 1989. These amounts are supposed to recognize amount of tax deferral you would have enjoyed if your company had been contributing to an RPP at that time. So if you worked for a company that did have contributions to RPPs or deferred profit sharing plans, then you don't get these rollover amounts. But for the purposes of this course, we're not going to throw that tricky rule at you. If we give you how long someone's worked at the company, figure out how many years they've worked before 1996, before 1989, and that will let you know how much of this retirement allowance can they put into their RSP and protect themselves from the taxes this year. If you have a direct transfer from your employer to the RSP, there's no tax withheld. So normally, here's your retirement allowance. We'll do the same tax deductions we normally would as we would on a paycheck. But if you're intending a certain amount's going to be transferred into the RSPs, that can be subtracted from that paycheck, so they won't even withhold the taxes. So you don't rely on getting that refund and then contributing the refund to the RSP, as that will affect your contribution space. We can save the taxes now, transfer that full amount on a tax deferred basis into an RSP. Doesn't affect your contribution space. No income tax will be withheld. So it's a pretty good rule. It's just you have to work at the same place for a long time to benefit from it. To give an example for doing that calculation, on December 31st, 2024, Mr. Bartoli retires after 46 years of service with his present employer. In recognition of outstanding service during this year, his years, the employer pays him a retiring allowance of $100,000. His employer has never sponsored an RPP or a DPSP. What's the maximum deductible contribution Mr. Bartoli can make to his RSP as a result of the retirement allowance? So we've worked at the company for 46 years. It's currently 2024 minus 46 is 1978. So that's the year that Mr. Bartoli started at the company. So we'll go into the solution. Year started is 1976. So we have to figure out how many years were before 1996. We've been working 18. How many years before 1989 was 11. So we have $2,000 times the number of years, 18, 36,000. And we have another 11 years at 1,500. That's 16,500. So combined, Mr. Bertoli can transfer $52,500 to an RSP or RPP in the year of retirement. So even though this amount goes down in 1989, you still have that $2,000 for prior to 1996. So this can accumulate if you've been working at a place for 40 years to a pretty sizable chunk of a potential retiring allowance that you can protect from taxes for now, immediately put into an RSP and have it help provide income for your retirement. The next amount you might get is retirement compensation arrangement. The thing about the registered pension plans is they're limited in their contributions. You're only allowed to contribute so much money in a given year. So someone who makes extensively high income is very limited on how much income they can. So if they have available to them $50,000 to save every year because their income's so high, they only get that tax deferral amount limited by their RSP contributions. So they can only save, 30,000 per year. Those limitations are meant to help everyday workers save for retirement to help support an everyday lifestyle. But high income individuals don't have the same lifestyle. So their companies that they work for might have a retirement compensation arrangement. They usually you'd only see this on large companies that provide this for their executive level employees. So a retirement compensation arrangement allows a company to contribute money into a special account that will be paid out to retired individuals. Due to limitations for RPP and DPSP contributions, RCAs provide benefits to allow highly paid executives to maintain their standard of living. The contribution to an RCA is fully deductible from the company who makes it. So the company puts, $50,000 into this account. It'll be held in that special account to be paid to the executive during the retirement. So if I'm the company and I put $50,000 into the account, that's an expense. I can deduct it from my income, and that payment is not taxable to the employee yet. So the executive has retired. We have $50,000 sitting in account. It's not going to be taxed in their hands until it gets paid out to them. So they are deferring taxes in their name. They also have no CPP or EI contribution requirements, so there's no tax deductions on this amount. The company says this is being put into an RCA. It's being held there until the executive can take it. They won't be paying CPP and EI on those withdrawals. But this is a pretty hefty tax deferral system for someone who already has a high level of assets and income for them. So how does the government sort of manage this? Well, what they do is they have a refundable tax. Any amount that the company puts into the RCA, they'll have to also pay contributions and earnings of 50%. So they'll get a $50,000 deduction from their taxable income, but they will have to pay an additional $25,000 to cover the taxes that this person would likely have paid on the $50,000. Once that RCA gets paid out to the individual, then the corporation gets that money back because the individual will pay the taxes that year. This refundable tax is meant to take away the deferral, not so much the deferral benefit, but to take away the deferral incentive, especially from the point of view of the corporation. If the corporation's going to offer this to their executives, it's like the corporation's going to, all right, we've put a contribution into the RCA, and we're also going to pay your taxes for now until you take on the money. And then when you pay your taxes, we'll get our contribution back. It's like they put a deposit on your taxes for the time being. So that deposit on your taxes is refundable when the RCA actually distributes that money to the beneficiaries. There's also an unfunded RCA. The employer enters into a letter of credit or surety bond arrangement with a financial institution and provides security in the form of a guarantee to employees that retirement distributions will be made. The employer makes distributions directly to the employees from corporate revenue, and the refundable tax is paid on letters of credit and surety bonds not recoverable. So in a regular RCA, the company has to put, like in our example, 50,000 into the account plus 25,000 in taxes. Now that's a lot of money to be out. So they'll have an unfunded RCA. So they won't put the money into the account, but they will have a letter of credit from the financial institution saying this account is for this person, this executive. We are guaranteeing that we are going to pay them a certain amount of money. The reason of doing this is it saves the corporation from having to put aside that $75,000. They will handle all the taxes when they physically pay the retired employee. But these accounts, unfunded RCAs, are expensive. You have to pay amounts on the letter of credit. You have to pay amounts on the surety bonds. So those amounts you'll still pay that 50% refundable tax, but because of this unfunded status, they don't get the refunds back at the end. So for the cash flow, it allows them to have more money in their hands for the time being, but they're going to be out more funds later because they won't get those refundable portions back. So it's kind of a decision on their part where they want to fund the RCA and get some money back in the future, or unfund the RCA, use the money now, but they're going to be out more in the long run. There is a proposal, the budget process. This is the budget proposal that removed their ability to recover the refundable tax. Salary deferral arrangements. I don't know if you guys remember discussing bonuses. There's three types of bonuses where if a bonus is declared and paid within 6 months, the company gets to deduct it when declared, and the individual recognizes the income when collected. If they go over 6 months, the company doesn't get the deduction in the accrual. They get the deduction when they pay it out to the employee. So it matches the income recognition with the expense from the corporation. Salary deferrals happen if an amount for salary is earned or declared, but not paid for 3 years. So we might have salary that a person earns while working, but won't actually get paid to them for their retirement. So the problem is arrangements established to defer taxation to year in which the bonus is received. So an individual might be declaring a bonus, but since in their mind, they don't have to pay taxes until it's received, what happens if they never receive it? I just declare bonuses, get the deductions in my company, and never pay those taxes until I collect it. So that's why they put the rules on salary deferral arrangements saying, well, if it's going to be 3 years before you pay it out, then that person has to declare the income now. We don't want the tax implications to be why they're deferring their salary. So the company gets the deduction, but the person has to recognize the income now, even though they're not getting it until later. So tax the employee when the benefits are earned, when they worked, if payment is more than 3 years after the payer's year end. The definition of SDA excludes bonus arrangements when the bonus is paid within 3 years, because we have those 6 months and over 6 months amounts as well. But this is focusing on years beyond, amounts being paid beyond 3 years. So this comes into play that if someone can accrue the income now, pay the taxes now, then they can have that money set aside to pay out in their retirement. But there's just no tax deferral benefit because you do have to pay the taxes for it now. But since those taxes are already paid, when you get that payment in 5, 6 years, there's no taxes on it. You just get that cash outright. Individual pension plans. So registered pension plans are provided by an employer, but self-employed individuals who have a very high net worth might say, you know what, I have the funds available. I can pretty much pay for my own pension plan and ensure that I will have enough coming to me to cover my retirement later. So a defined benefit plan established for a single individual, usually marketed with insurance products and requires use of actuarial valuation, able to make past service contributions and transfers from other registered plans. So let's say I was working, I have some RPPs from past employers, and now I've gone into work for myself. I want to continue contributing to those plans to cover because I want to retire one day. So I want to have that defined benefit. I can transfer those RPP amounts in. I can continue to fund the plan myself to ensure that that defined benefit is preserved. Because one day I'm going to stop working and I want to make sure my retirement is covered. Um, I haven't seen these too often, partly because individuals who have that level of income to cover a pension plan are usually um, comfortable investing and trying to earn a greater return than what the defined pension plan would offer them. But also, it is so partly it's because they like to have the funds themselves, partly because insured pension plans, when you are rolling over from an RPP, you're only allowed to roll over 50% of the defined benefit RPP to IPP. So you're only allowed to transfer over half. The other half needs to be recognized in income right away. So if I scroll back up to slide 65, we have these tax-free transfers. So RPPs, if you transfer from a defined benefit RPP into an RSP, half can be transferred tax-free. The other half has to be recognized in net income. And part of that has to do with sort of the asymmetry between the contributions that were deducted from income and the defined benefit output. So if you're trying to cash out this defined benefit for a certain amount of years, you have to recognize half of that income. So individuals wanting to make this transfer often don't want to recognize that half amount of that 50% of the transfer in their income right away. So they tend to just leave it as is. But that's not to say they do exist. It takes a certain amount of financial security in your current period to fund your own defined benefit plan. So this is usually done through insurance products. You pay premiums on insurance, those premiums will be invested, and if they make a certain amount of return, they will also fund a pension amount. But yes, that's a very specific case. I don't know if there's any questions related to individual pension plans for the quizzes and exams, but be aware of it and that it is an option for select individuals. Okay, so that ends chapter 10. As I said, the overall priority of this chapter is RSPs and those calculations for the home buyers plan and lifelong learning. Be aware of the contribution limits for money purchase plans and defined benefit plans. Make sure you understand how to calculate your contribution limit, that 18% of earned income. Otherwise, the rest of the questions are make sure you have just a broad understanding of when is contributions to pension plans included in income, when can we benefit from the tax deferral, and what other options do we have outside of registered pension plans to perhaps set aside funds for retirement. Thank you for your time. In our next video, the next video, I will see you in the next chapter. Thank you.